Hey guys, welcome back. This is yours truly, Kevin Thompson, on this 980s podcast station. And today on this Econ 101 segment, I'm here to explain something that's being asked to me. Hold off. Kevin, I don't understand this market. I don't understand why we're at all-time highs. It makes no sense. We're getting bad numbers economically, but yet the market just powers through them. There's a war over here, yet the market powers through them. What gives? Well, I'm here to answer these questions and enlighten my audience. It's like they say in Texas, saddle up. So, yes, markets continue to rally. We're having new daily highs. So why are stock markets rallying while consumers feel stretched? How can both things exist at the exact same time? Well, the answer lies in understanding how inflation works, how GDP works, how corporate earnings tie in, and ultimately how spending actually interacts with all of this stuff. Because the reality is this: the stock market is not measuring how people feel. It's measuring cash flow, earnings, liquidity, things of that nature. So I'm going to start off by saying this. Inflation is good for stocks at first. One of the biggest misconceptions people have about inflation is believing inflation is automatically bad for corporations. Not necessarily. When prices move up, corporations move prices up also. If your groceries go up 8%, restaurants prices go up 10%, airline tickets may rise 15%, or insurance premiums may double. That revenue flows directly to the corporate earnings. A lot of companies are not necessarily selling dramatically more products. They're just charging more for the same product that they had on their shelves. And Wall Street loves it. So when you hear corporations beat earnings expectations, you have to ask yourself, did they truly grow, or did prices simply rise enough to offset weaker demand? Because inflation can mask underlying weakness for a very long time. Now, eventually, there's an inflection point. There's a level where consumers finally say, enough is enough, I'm done. There's a buyer's revolt. That's called the destruction of demand. People stop traveling. They stop eating out. They delay buying homes. They stop discretionary spending. But we haven't hit that wall yet. We haven't fully hit that wall yet. Consumers are strained, but they're still consuming. And as long as corporations can continue pushing prices higher without materially collapsing demand, earnings can remain elevated. That's one reason stocks are climbing. The second reason is the inflation versus consumption dynamic. So what happens when consumption slows? That's a fair question. Because consumption is the largest part of the U.S. economy, roughly 65 to 70%. But here's where inflation becomes incredibly important. Sometimes higher prices themselves can offset lower volumes, meaning you can sell fewer units but make the same amount of revenue because prices rose enough. Simple example, if a gas station sold 100 gallons of gas at $3, that's $300 in revenue. But if the consumer cut back and only buys 90 gallons of gas, yet the price rises to $4, revenue becomes $360. Less consumption, higher revenue. That's inflation offsetting weaker demand. Add in what we've seen in the grocery stores across energy prices, food, utilities, insurance, and consumer staples. You can see why prices continue to move higher. The economy may feel weaker to households, but nominal economic activity can still appear strong because prices are elevated. That distinction matters because GDP measures dollars flowing through the economy, not emotional sentiment. Now I'm going to geek out on you a little bit. So we're hearing these GDP numbers, and they weren't necessarily that great coming previously, but we're hearing these GDP numbers. This is why I say GDP numbers may be better than expected. Don't be shocked if they're better than expected. But GDP is basically C plus I plus G plus X minus M. What that basically means is you have consumption, investment, government spending, and then X minus M is net exports. So people ask, how is the economy still growing? We have wars in Iran, wars in the Ukraine, battles in Venezuela, Cuba, unrest in Nigeria and parts of Africa due to what the United States is doing. How can we still be growing? Well, let's look at the components of GDP. Consumption may slow, but inflationary pressures, like I mentioned previously, can still keep nominal numbers elevated. Higher food, higher energy costs, higher retail prices can offset that loss of consumption, even if people buy slightly less. Now, investment. This one is massive. We've seen massive AI investment. We've seen massive chip demand. Tech companies are spending not hundreds of billions, trillions of dollars. Data centers, AI infrastructure, semiconductor capacity, energy demand, cloud computer, water infrastructure. Silicon Valley has essentially sold the world on an AI arms race. And now we are too invested to stop. The question is whether it's sustainable long term. But for now, investment spending has been incredibly robust and markets are rewarding that. So in the I, massive investment. Now, let's go to G, government spending. Massive defense budgets, DOJ expansion, infrastructure spending, interest expense, veteran benefits, entitlement obligations. Even when government workers leave jobs through layoffs or early retirement, the obligation often remains. Remember, there's pensions. Severance remains. Benefit costs remain. Government spending doesn't disappear overnight. And when you run persistent deficits, that money continues circulating throughout the economy. Now, the big one, net exports. And I keep saying it big over and over again, but it's all huge. Geopolitical instability here. When oil supply chains become stressed globally, whether it's disruptions around the Strait of Hormuz or broader energy instability, countries start looking for alternative suppliers. That could benefit the United States energy exports significantly. WTI crude, natural gas exports, energy infrastructure. If we export these things, and that causes a rise in our exports versus what we're bringing in, that's a bump to GDP. And suddenly GDP looks stronger than people expected. So don't get alarmed if you see a higher GDP number in the near quarters, because this is what is happening. So GDP, inflation, demand destruction, supply constraints. Why are stocks rising, Kevin? Let's tie this all together. Stocks care about earnings, liquidity, growth, capital flows, future expectations. That's it. If nominal GDP remains positive and corporations continue growing earnings as they should, and investment remains elevated as it is, and the market can continue moving higher. Even if consumers feel exhausted, that's the disconnect people can struggle with. The stock market is not Main Street. It's forward-looking price mechanism based on future cash flow expectations. Now, here's where it can get dangerous. The entire system works as long as economic growth exceeds the cost of servicing that debt. That's the key. If GDP growth remains above the interest expense cost of national debt, the system can theoretically continue functioning. Not perfectly, but sustainably enough. However, once growth slows materially and interest expense approaches or exceeds that GDP growth number, things get dicey very, very quickly. Because now debt compounds faster than productive growth, and that's where confidence can break down. Now, again, the American government is not a household. Always remember that. It is not a household. A household cannot create currency. I'm going to say it again. A household cannot create currency. But when you think about it on a smaller level in your own household, when you're paying more interest out than you're actually bringing in or making in your investment portfolios, you're actually losing out in regards to your overall returns, in regards to your growth of your quote unquote, your net worth. So again, it's not a household because households can't create currency, nor can they, well, they can theoretically control the rate of interest by, consolidating and things like that. But that's the main thing. Like, you can't create currency. So the real concern no one talks about is, this is what I think people aren't paying enough attention to be honest with you. U.S. interest payments on the debt are now rivaling and in some cases exceeding portions of our United States military spending. Think about it. The cost of servicing our debt is becoming one of the largest line items in our federal budget. That matters because eventually governments face hard choices. Raise taxes, cut spending, inflate away the debt, which again, you can see that right now, borrow more, or suppress interest rates artificially. Again, historically, most countries choose inflation. Most countries choose inflation because inflation quietly reduces the real value of debt over time, which circles us back to why markets often rise during inflationary periods. Hard assets rise, corporate revenues rise, nominal GDP rises, but eventually the consumer reaches exhaustion, and there's a balancing act we're all watching right now. So in closing, when you see markets at all-time highs, don't automatically assume the economy is healthy underneath the surface. Sometimes markets are rising because inflation itself is inflating revenues, earnings, and asset prices. The question isn't whether inflation is helping markets right now, because it clearly is. The real question is, how long can consumers absorb it before demand finally breaks? Because once consumption materially falls and investment slows and GDP growth stalls while debt costs remain elevated, that's when the music stops very quickly. And that's what markets are constantly trying to price ahead of the time. We have to remain diligent. We have to remain diligent and understand that most of us, although we have feelings about what's going on with the current market, we cannot allow our feelings to make investment decisions because there's not only a number, but an understanding on how markets actually work. And that's what I'm here to bring to you today. Give you an idea and remove the feeling so you can see that there's math and there's logic to this. So when markets go up, you understand why. Thank you guys for listening. Until next time, stay humble, stay safe. See you again soon.